Evening, everybody. And for those of you on the East Coast, I'm very impressed that you're still making it this late at night for you guys. Yeah, so my name is Ron Ricard. I work for a company called Investment Property Exchange, or IPX 1031. I do have a PowerPoint that I'm going to use, if only because when I find it on Zoom, it helps keep things more. Helps keep things a little bit more even going here. So um, one thing I do recommend is that we will, if you got questions right now, put them in the chat box, and then once I'm done, it's about a half-hour presentation. Then we can get into more Q&A. But so I've been doing this about 20 years. Started investing just about the same time, saw everyone making money on real estate, and decided to do so. I own about 6 properties scattered across the Western United States, and survived the crash of 2008-9. And fortunately, those properties have held. Some of them lost a lot of money. Almost all of them came back to better than they were before. So let's chat with the people later about their investments and what their strategy is. But what I'm going to do tonight primarily is talk about 1031 exchanges. And I kind of like it, and when I talk to principals like you, I really like to focus on basically all of your real estate. What are some of the real estate, a lot of us own real estate. Most of us own a primary residence. Some of us own a second home. Some of us own investment real estate. And 1031 is a fantastic tool. In a lot of ways, it can be used for all of your real estate. And so what I'm going to do is kind of talk about 1031, but encompassing on all real estate classes. There is one question I know everybody's going to have, so I'm going to address it right now. Is 1031 exchanges going to go away? Some of you said, I've heard that Biden wants to do away with exchanges or whatever. That is not true. There was some talk about limiting 1031 exchanges to certain income levels, primarily based on the idea of as a pay for, as Congress calls it, for some other programs they want to do. However, we have been in discussion with his finance people, and we have very strong support in Congress for 1031 exchanges because it almost went away back in 2017 with the Republicans in charge. But we were able to educate people about the benefits of exchanges, and now we have a lot of people in the Congress who are really fighting for us. So I'm really not worried about 1031 exchanges going away. I think there may be certain things that might happen, like the capital gains tax may be increased, which actually will increase the number of people doing exchanges. But I really don't see 1031s themselves going away. As a side note, most of you probably don't realize this, but 1031 has actually been part of the tax code for 100 years. Been around since 1921. Survived all kinds of changes in Congress and tax codes all those years. So, we have a pretty solid base behind us. All right, so let me kind of, what I'm going to do is I'm going to kind of use the platform of what 1031s are to go into all these topics. So let's start with what are exchanges. 1031 is just a section of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you've made. So what does that mean in English? You got a rental house. You're tired of that rental house. You want to sell that and buy a fourplex. So you list the property. Jason hopefully lists the property for you. At the close of escrow, the money comes to a third party called the intermediary. That's what we are. You then go find that fourplex, and we send the money to the title company on that side. So you're selling something, you're buying something. Our job is just to hold the money in between. And when you do this, you get to defer paying taxes on the profit that you've made. Now, that's an important word. 1031 is only deferring the taxes, not eliminating taxes. So if you got a property that if you got a property, let's say you got, $300,000 of a gain in the property, you exchange it to the second property, then you sell that second property, you're going to pay taxes from the first property and the second property. So it is just deferring the tax. Now, some people might ask, well, why bother? If I'm only going to defer the taxes, why bother doing an exchange? Well, the way I look at it is this: would you want to pay your taxes today or tomorrow? For most of us, the answer is tomorrow. Okay. The way I look at it is this: if I make $300,000 of profit on my rental, and I got to pay 100 to the government, I only got 200 to reinvest. But because you can do the exchange, you can reinvest all 300, and that 100,000 bucks you're not paying the government yet, you get to use that to buy more real estate. But the real reason you do the exchange is because ultimately, hopefully, you never have to pay the taxes. Why? Because ultimately, sadly, one day we're all going to die. And when you die, you win. Because when you die, whoever inherits the property from you, they get what's called a step up in tax basis. And that allows them basically to wipe away all of the gains that you made. Just make sure we're all on the same page here. I bought a property years ago for 100,000 bucks. Today it's worth 500,000. If I sell it, I have to pay tax on $400,000. But the day I die, whoever inherits the property from me, their basis on the property is the value of the property when I die. If your kids are like mine, the day after my funeral, they're selling everything. They sell it for $500,000. That's what it was worth when I died. That's their basis. So when they sell it for 500, they have zero gain. All the capital gain gets wiped away. So that's the real beauty of the 1031 exchange. That's why the motto of our industry is swap till you drop. Hopefully, you never have to pay the taxes.
Real quick, Ron.
Yeah,
So, does the step up in basis, does that matter if it's only primary residence or if you hold it in an LLC? Like, does how does that come into play?
it's on all of your assets. It's your primary residence, your investment real estate, your stock portfolio, your art collection. It's on all of your assets.
Okay, great. Thank you.
Yeah, no problem. All right. So one thing is some of you heard the term like kind. Like kind is a very confusing term. I'll make it real simple for you. All real estate is like kind with all investment real estate, I should say, is like kind with all other investment real estate. You can sell uh, a rental house and buy commercial real estate. You can sell agricultural property and buy apartment buildings. You can sell land and buy commercial. Also, anywhere in the U.S., you can sell in California, buy in Florida, sell in Florida, buy in Hawaii. You are all deferring state and federal taxes, even if you buy in other states. So the term like kind is a little bit confusing because the term like kind, a lot of people think it has to do with a house for house or residential for residential. And what most people don't realize is up until very recently, we did a lot of exchanges for things like cars and equipment. I did exchanges for farm equipment, for airplanes, for livestock. And that's what like kind of referred to. If you sell a boat, you got to buy a boat. You sell, hotel equipment, you got to buy hotel equipment. But 1031 exchange for personal property disappeared in 2017 as part of the tax code rewrite in 2017. Now 1031 is only about real estate. But more importantly, it's still any kind of investment real estate for any other kind. Don't get too hung up on the term like kind. Now, I did say it has to be investment real estate. Well, most of us own other kinds of real estate. So what kind of real estate do most of us own? Well, first, our primary residence. Our primary residence is governed under a different section of the tax code, section 121. That says if you live in the house at least 2 years, you get an automatic exemption. If you're single, you get to keep $250,000. If you're married, you get $500,000. But for some people, that isn't enough, especially if you live in the LA area or Bay Area or areas where prices of real estate have really gone up. It's not uncommon, it's actually very common in some areas for people's primary residence to have more than $500,000 worth of gain. What about them? What can they do if they don't want to pay more taxes? Well, believe it or not, there are ways you can combine 1031 exchange with your primary residence. So first off, is there any portion of your property today that you are deeming as investment or business real estate? I'm sure Jason is a realtor. He probably has a home office. If he's declaring that home office on his tax return as business real estate, well, then whatever percentage you are declaring to the IRS as your home office, that percentage of your sales price you can do an exchange on. Maybe you have an ADU or rent out the basement. Again, the key here is if you are declaring any portion of your property today as investment real estate, that portion of the property you can do a 1031 exchange on. So this is a really good thing to know if you got a highly appreciated primary residence and you have, you're also using your property for other uses. But most of us, like me, do not have people living here other than myself and my wife, and we do not have a home office. So is there anything else we can do if we don't want to pay taxes? The answer is yes. Move out. Turn your house into an investment property. Now, after renting it for a couple of years, is that house now an investment? Yes. Is that house still considered to be a primary residence? Yes, because it still meets the criteria of having lived in the property 2 of the last 5 years. So now when you sell the property, you get to keep $250,000 or $500,000 and do an exchange on the rest. So this is actually something that we are seeing a lot of people do. I'll give you a good example. I'm probably doing one or two of these every single week. It's becoming really common. But a good example of this is the couple I did one for last year. Um, they had this house that in what's called the Los Altos Hills area near Palo Alto. It was worth $3.5 million, and they bought it for a couple $100,000 years ago. They had a $3 million gain in the property, and if they were just going to cash out, they're looking at writing an $800,000 check to the government. Well, instead, they rented out the property for about a year and a half. Their tenant moved out. Their accountant said close enough. They sold the property, but before they did that, they borrowed a little bit of money against the property. They moved to this huge house in Southern Oregon that they bought for $500,000. They converted the property into a rental. When it sold, they were able to keep the $500,000 and take that other $3 million and go buy, in this case, triple net commercial real estate. I think it was a McDonald's in Los Angeles. And they were able to not have to write the government a check for $800,000 and instead turn that into an asset that's giving them like $14,000 a month in net rent. So it's a pretty cool way to combine the 1031 with the primary residence. So, the way I look at it is if you have highly appreciated primary residences, there are ways to get around paying taxes. You just got to do a little bit of planning. All right, what other properties don't qualify for 1031? Flips. Yeah, some of you, I'm sure if you're into real estate, are into flipping real estate. Well, flipping real estate does not qualify for 1031. Flipping real estate is considered to be property held for resale. So you buy it, you fix it, you sell it, you pay taxes. Same thing with development. You buy a piece of land, you build a house, you sell it, you're a developer. Spec houses are not considered to be investment. How about second homes? Second homes are also not investment real estate. Now, when we say second homes, it's not just that little house that you like to go to on weekends. It's also a property that you are letting family member use. So the main thing is if you're letting family member live in a property and they're not paying market rate rent to the IRS, it's not investment real estate. So when you sell that property, you're going to have to pay taxes on whatever gain you have in that property. So if you got a family member living in there, make sure you're treating them like a regular tenant. Now, I do want to distinguish: second homes do not qualify for 1031, but vacation rentals do. And the IRS has actually given us what's termed a safe harbor definition of what a vacation rental is. I call it the 222 rule. You and your family's personal use of the property cannot exceed 2 weeks per year. You got to rent it out at least 2 weeks per year, and you need to do it for 2 years. So if you got a property that's currently a second home, you want to convert it into a vacation rental in order to be able to do an exchange, this is the IRS recipe to do it. You need to rent it a few weeks, don't use it more than a couple of weeks, and after 2 years, this property now has an IRS definition of investment real estate and qualifies to do a 1031. So this is also a way people will, when they want to buy a property that ultimately they want to move into, this is the safe harbor that they use. So you buy it, you use it for 2 years as a vacation rental. After 2 years, you can pretty much do whatever the heck you want with the property. Call it your second home, your primary residence. It doesn't matter. You've met the definition.
Ron, if I may,
Please.
Real quick. So is the time limit 2 years or is it 1 year? I hear a lot of times people say you only need to hold it for 1 year.
Okay, so let's talk about that. The well, first, I always get the question, how long do you have to rent a property before you can move in? And the tax code nor the IRS has ever given us any direct definition of how long you need to rent a property for. However, in 2008, they actually gave us this definition of a vacation rental, where they explicitly said for a safe harbor definition, which means if anything a safe harbor is, we can't challenge you. You follow these rules, you are golden, doesn't matter. And here in this one, for a vacation rental at least, they gave us a 2-year definition. Now, that doesn't mean that less than 2 years is not safe, but it means if you do it for 2 years, it is. So, what I always tell people, it's a question that they need to discuss with their own tax advisors. Most tax advisors, will use this as kind of the blueprint and strongly suggest 2 years. I've seen people suggest 1 year. Bottom line is, I don't know where they're hanging their hat on for that one, because I've never seen the IRS issue anything about 1 year being long enough to do it.
And quick follow up, the safe harbor, the 2 years, you're saying that's only for vacation rentals or any other kind of investment properties as well?
This is what the IRS gave us when it comes to vacation rentals. But this is the first time that they've ever given us anything with an actual time frame. So if they have not given us the same time frame for a property that's a permanent rental or anything else. So again, we don't have any. We have nothing else, no other place to look at other than how the IRS actually defined vacation rental.
Okay, so what I'm hearing you say is vacation rental, they did give specific time frame. Everything else, it's kind of loose. Check with your financial or tax person. You might be okay with 1 year, but maybe 2 year would be safer.
Right, yeah, I mean, again, 2 years is usually considered safe. Mostly they're using this, but there is a chance they might suggest something a little bit less. Again, it really depends on your personal situation. I mean, if you have a valid reason, maybe your house got burnt down in a fire or something, or maybe you got a job change that happens to move to Arizona where you happen to have your rental property. You might have a valid reason why it can be less than 2 years, but if nothing changes, again, you wanted my thinking is always, I never want the IRS knocking on my door for any reason, so I'm not going to give them any reason to even ask questions. But this is the kind of stuff you need to discuss with your own tax person.
Okay, great. Thank you.
All right. Now, there are a couple rules about 1031 that you guys probably already know about, but I'm going to go through them real quick. You have a real strict time limit when it comes to exchange. 45 days to identify what you're going to buy, 180 days to actually buy it. So 45 days to give us the actual address of what you're going to purchase, 180 days to close escrow. Now, another question I'm getting right now, because of this shelter in place, pandemic, COVID situation, whatever the hell you want to call it, are there extensions? Can I apply for an extension if I get sick? And I want to be real clear about the extensions. The I have the authority to grant extensions to this 45 and 180-day rule. And they do so typically when there is a federally declared disaster. So if there is an earthquake, a hurricane, tornado, then the IRS can issue extensions. In April of last year, actually issued extensions because there was a federal declaration because of our pandemic situation. And so if you happen to have sold your property last March or April or May, you actually got an extension on your 45 and 180-day deadlines. Very importantly, though, those have expired and there are no more coming. Now, later in the year, we actually in California got more extensions because of the fires that happened. So San Francisco, no, San Francisco, San Mateo, Santa Clara, Fresno, Napa, Mendocino, Shasta, I think Santa Barbara counties, Ventura, got extensions back in August because of the fires that happened. But very importantly to realize, you cannot individually ask for an extension. That those extensions, that's if you get sick or something happens to you, doesn't matter. So 45 days, what does 45 days means? 45 days, in 45 days, you need to identify, give us the exact address to the property you are purchasing. Now you can identify multiple properties. Most people identify up to 3 properties, but you got to buy from that list. During the 45 days, you can change your mind as much as you want, but once midnight strikes on day 45, whatever you've identified, you are locked into. Now, one other thing about the 45-day rule, remember it's the day escrow closes. So another thing I'm seeing a lot of people do right now, because of lack of inventory, is ask for longer escrows. I'm seeing a lot of 45, 60, even 90-day escrows. If in the longer the escrow, the longer before the clock starts. So to the degree that you can, get the buyer to agree to a long time before the escrow closes, that's that much more time before your 45-day clock starts. That's one way around it. Now, I will say also, there is something to get around the 45-day rule completely, and that's called a reverse exchange. A reverse exchange is exactly what it sounds like. It means you're buying first and then selling. I'm not going to get into details about reverse exchanges. I get a whole division. That's all they do. I will note a couple things. One is it's a lot more expensive of a transaction. You're looking at, $6,000 to $10,000 versus about $1,000 for a regular exchange. Also, you got to have the money to buy that property because you obviously haven't sold your property yet. So you need to have the money, and getting a loan isn't really easy when it comes to a reverse exchange. But bottom line is, if you got somebody is in that situation where they want to buy first, call me. I'll walk you through how that actually works. But for most people, 98% of the exchanges that we do, you're selling first and then buying.
Ron, real quick, I think there is an exemption for that 3 property 45-day limit. Is that right? Can you talk a little bit about that?
Yeah, there are 2 different rules that you can use. I wasn't going to get too much into the identification, but there are. If your goal is to buy more than 3 properties, I did an exchange. I'm doing an exchange right now. It will open today, where the guy's selling his property in San Jose for $1.5 million, and he's going to go to Texas and look for $300,000 properties. Obviously, he's going to buy more than 3 of them. You can also do it on a dollar limit, and the dollar limit is 2 times the sales price. But again, that's if only. Don't confuse them. If you're identifying 3 properties or fewer, there's no dollar limit. More than 3, that's where that dollar limit kicks in. So if you sell $1 million property, you can identify $2 million worth of property. So that's how you do it typically if you're going to buy lots of small stuff.
Okay, great. I mean, I guess they don't want you to just go out and identify every property in your neighborhood or, under the sun.
Exactly.
So,
or I'm going to buy something in this condo development of 500 condos. No, you got to give us the exact unit. Sorry,
yeah,
guys.
great.
Right.
How's this, everybody? How are we doing? How's Ron doing? You guys finding value in this? If you are, type in the chat box the word value or dollar signs. But we'll keep this going and keep the questions coming. We'll try to make sure to get to all of them as much as we can at the end.
Yeah, I'm almost done. I just got a couple more things real quick to go over, and then we can obviously open up for questions. Real quick, how much you need to reinvest in the exchange? Real simple, everything, not the equity, not the profit, everything. You want to buy, if you sell your property for $1 million, you got to buy for $1 million. If you buy for more, no problem. If you buy for less, you pay tax on the difference. So equal or greater in value, and all the cash that comes from the sale all has to go to the next property. Anything that you touch, you pay tax on. So that's the key about the exchange. You got to reinvest everything. Rule of thumb, real quick: did you buy something equal or greater in value, and did you use all the equity that came out of it? As long as you did that, you're deferring all your taxes. Now, here's kind of one of the things I like to talk about is why people do 1031 exchanges. And the off-the-cuff answer that I get from most people is, well, I want to defer taxes. Well, that's not really true. That's not why you do an exchange. You do an exchange because you want to buy something better. And what does better mean? Better means whatever the hell you want it to mean. It could be, I want to sell my big office building and buy lots of small properties. It could be, I want to sell my 5 small properties to buy a big property. It could be, I'm moving to Texas, so I'm going to move my rentals to Texas. It could be, I need better cash flow. It could be I'm running out of depreciation, so I need to buy something that's going to give me depreciation. I do a lot of exchanges for older people who are looking to set up their estates so that each kid knows what they're going to inherit. The reason I pointed out this way is whenever you think about selling a rental property, it's not a matter of do you want to defer taxes. What you want to ask yourself is, what is a better property for you tomorrow than what you own today? What more do you want out of your real estate? When I give this class in person, I start asking people how long they've owned the real estate, and one thing I've kind of come to a conclusion: anytime anybody has owned a piece of real estate of investment real estate more than 10 years, 95% of the time, if given their option, they would get rid of it. 95% of the time, they would sell that property given the chance. And 1031 is the tool that allows you to do that. And this is what's really cool about real estate. Real estate is the only asset class that you can sell and not have to pay the tax man every single time. You got a stock, a bond, a piece of art, you got something that you made money on. If you're going to sell it, even if you're going to buy another mutual fund or stock or piece of art right afterwards, doesn't matter. You're paying tax on whatever that gain is. Now with 1031 exchange with real estate, you don't have to. And so that's what makes real estate really special. This is the one tool that really sets real estate apart from all other investments vehicles, is that you can keep building, keep changing your properties and not have to pay the tax man every time. So when you think about 1031, think of it as a great tool to get from the property you own today to the one you want to own tomorrow. Last thing, just real brief. Sometimes I talk to people, especially people who are older, and they want to figure out what to do with their real estate now. I'm sick of owning my rentals. What do I do? You can always pay the taxes. Dying is a great tax strategy, though I never recommend it as a good option. Seller financing is always a way to get out and stretch your tax payment over many years. One of my favorites: do an exchange into a property that later you're going to move into. I'm going to sell my 3 crappy little rentals out in the Central Valley and buy myself a condo in Hawaii, so that after renting it for a few years, I'm going to move to Hawaii, move into my condo, live there the rest of my life. Great tax strategy. Again, you can do it for estate planning. Another thing a lot of people do is buy low maintenance properties. The last one is pretty well known, called a triple net or net lease. That's where you're buying a McDonald's, a Starbucks, Jiffy Lube. That's where you're buying basically a piece of real estate and you're leasing it to a major corporation to run their business. I've seen government buildings. I've seen universities that are available. And again, this is a great exit strategy if you basically want to cash in your chips and get into something that you don't have to worry too much about managing and have predictable cash flow. So anyway, that hopefully gives you an overview of exchanges, how you can use it for your investment real estate and your other real estate with enough planning. And I will leave it to questions at that point. Jason, I don't know if there's anything in the chat box that is a question mark, but if not, if you have questions, or you can open up to everybody else.
Yeah, great. Thank you so much. I mean, Ron's contact info is here. Is it okay if I share with folks your contact info later, or if they request
Yes,
it?
absolutely.
Okay.
I'm here to be a resource. I have clients all over the country. So feel free to share my information with anybody, with any of your clients or any of your friends. No problem.
Okay, great. And I mean, I have some questions or things I want to make sure we touch on given our audience, but I'm actually gonna save that for the end if we have more time. But Tracy, if you don't mind turning on your mic, feel free to ask your question about the home office earlier.
Cool. Thank you, Jason. Ron, really appreciate your time. So I had a question about the 1031 to like your primary residence example. So what would you define as like a home office? So for example, I'm not an active investor right now, but I am using my office to learn about real estate, but I'm also using it for my 9-to-5 remote job. How would you generally define that and claim that on your taxes?
Well, the good news is the IRS has actually, and to be honest with you, I don't know if it's part of the tax code or just a revenue procedure from the IRS, but there is actual IRS, your accountant has guidelines as to what makes a property qualify for 1031 and what doesn't. And one of the things that changed in the tax rewrite of 2017 is that before, someone like me who works a corporate job, not corporate, but I mean, I work for a big company. Um, but I work from home. I was able to take my home office deduction, but now I can't anymore because W-2 employees cannot take home office deductions for that job. You have to be a 1099 employee. But your accountant actually has something that this is what makes you qualify for a home office deduction, and more importantly, how to determine exactly what percentage of your property does qualify. And they've actually loosened up the rules on this so that now much more of your house qualifies as investment or as your business property than many years ago. Many years ago, people were afraid to have home offices because it was a guaranteed audit by the IRS. Now, not only is it not a guaranteed audit, it's actually easier to qualify, but you just want to make sure you follow those rules. I'm not an accountant. I couldn't tell you exactly what they are, though.
Thank you, Ron.
Alvin, do you want to ask your question about the 1 year hold period, but I think you have another question real quick about short-term rental, 14 days.
Yeah, yeah, I think you answered the question earlier about the 1 year hold. But I do have a question about 14 days, because you mentioned 14 days for it to count as a rental property. Does short-term rental count as to be considered as short rental property at that point? Does it qualify it?
Yeah. So Airbnb, VRBO, and short-term rentals, as long as in total you're renting it at least 14 days per year, that qualifies towards that vacation rental definition.
So per year, you said per year, not
year.
14 days total, but 14 days per year. Okay, right, got it.
So for year one and year two, in each year, you got to rent it at least 14 days and don't use it more than 14 days.
Yeah,
got it.
Alvin,
Okay.
and I think that's consistent with the regular tax code. The distinction between a vacation home and a second home is like, you can go stay at your vacation home or short-term rental for 14 days, but longer than that, they start saying, okay, this is actually a second home. And I think that part's pretty consistent with my understanding.
Yeah, and now I understand also that you could have maintenance days in there, stuff like that. When you get to that level of detail, again, ask the accountant. You may be able to use it for more than that if you're using it to do maintenance on the property. But again, talk to your accountant about that.
And actually, if I may, since we're on we're kind of retouching on the 1 year, 2 year time frame, there's people talks about how you only have to demonstrate intent if you end up selling, say, shorter than a year or 2 years. Can you sort of demystify that a little bit, Ron? Like, is it true that you say you intended as an investment property, but something happened and you had to sell or something?
Right, and so that's the term intent. I'll give you a good example. A question I get all the time is, how long do you have to own a property for it to qualify for 1031? And the answer is, we don't know. There's no specific amount of time. A year, some accountants say a year, some say 2 years. I personally had a situation where I bought this fourplex out in Arizona when the market was going crazy 15, 16 years ago. 3 months after I bought it, I got a letter from somebody offering to buy it for like a $50,000 premium. I said, sold. I called my accountant. He said, no problem. You bought the property with the intention of it being a long-term investment. You hold all your other properties as a long-term investment. And he was comfortable defending me if I got audited, which I didn't, fortunately, that I got something that was unexpected. I have another situation where I know a client who 3 months after buying a second home got unexpectedly divorced. Her accountant was comfortable with her moving into the property right away because, again, she bought the property with the intention of it being a vacation rental. Something happened, in this case, an unexpected divorce, and she moved into it. So, again, the key is, what do you think is a defendable position? And if you and your tax advisor are okay with it, then great. It's just more a matter of there are going to be, you can't just say, well, I felt like it or something pretty stupid. And if what I always tell people is a lot of it also depends on your history. If you flip real estate and then all of a sudden you want to do an exchange and you've only held a property for a year, chances are you're going to get an audit. Whereas if you've always held your property for long term, you haven't hold one for only 6 months, chances are you're probably going to get away with it because you don't have the track record of flipping real estate.
And this might be a little bit out of your purview, but how do you demonstrate intent, like something in writing, or say like, hey, I've just emailed that to my realtor at that time?
That's between you, your accountant, and God. I always tell people, I mean, in my case, I got that letter. I kept that letter because it was offering me, so if someone wants to offer you a great price for your property, even though you haven't held it long enough, just keep that letter because that's my proof, quote unquote, that something unexpected happened.
Okay, great. We're gonna keep this moving. I think next question, Nathan, are you able to turn on your mic and ask your question?
Yeah, and thank you so much for the presentation, Ron. That was really insightful. I was wondering if a property was originally bought as a second home, can that be reclassified into a vacation rental or primary residence so we can take advantage of the 1031?
Yes, exactly. I'll give you a perfect example of this. A real estate broker, friend of mine, called me up and says, I need you to meet my sister. His sister had this beach house in Aptos, south of Santa Cruz. And it was a second home to them. They were there every weekend and stuff. And then all of a sudden, kids graduated from college, they stopped going, and they said, we literally have not been to that house in 3 years. And they were going to sell it and have like a $2 million gain in this property. So said, stop, don't put a for sale sign there, put a renter in there for 2 weeks this year, for 2 weeks next year. And then when you sell it in 2 years, now you've reclassified that property as a vacation rental because you met that criteria for the 2 years before you sold it. And therefore, and that's exactly what they did. 2 years later, we did the exchange. And in their case, it was interesting because they did the same thing on the opposite side. They bought a house in Park City, Utah, rented, and then what their plans were vacation rental for 2 years. After 2 years, stop renting it, just have it as a second home for themselves again.
I see. Thank you so much.
Anthony, do you want to turn on your mic and ask your question?
Yeah. Hey, Ron. So yeah, you mentioned, I think you explained what a triple net was. Can you explain also what a TIC and a DST are?
Yeah. I know I was getting a little bit long on time, and you guys are more, it sounds like you guys are much more of the active investor mode, so I didn't get too deeply into that. So the other kind of passive real estate is typically thought of as a DST or TIC. And what that is fractional interest in commercial real estate. There are companies out there who will buy a 100-unit apartment building or a Walmart or a big commercial center. And instead of it going to one person, they create this trust around it and they sell it to you in fractions. So if you got, as little as $100,000, you can buy a piece of a large piece of commercial real estate. And the advantage is because it is deeded real estate to you, it qualifies for 1031. And again, just like a triple net property, you don't have to manage it. You don't have to worry about the tenants, and you just get the cash flow from it. The key here is that you do need to be an accredited investor to be able to get into these things. And you do lose control because you don't decide when the property is bought and sold. So it's not really for everybody, but for a lot of people, it really works. And a lot of people will also use that to kind of fill in on their exchange. I got a client a couple months ago. He sold his property for $1.3 million. He bought something for $1.1 million. And then when he realized he was going to pay tax on that other $200,000, he put that into a DST. So it deferred the rest of his taxes. Side note there, this is not a REIT. An REIT does not qualify for 1031 because an REIT is not direct ownership of real estate. So that does not qualify. So there is a distinction between a REIT and a DST.
Yeah, so I know a good amount of our audience, they invest in syndications, either GP or LP. the TIC is how, because technically, if it's not set up as a TIC, it's not a like-kind exchange, right?
That's a great point. And the funny thing is, I updated my slide in one of my presentations, but not in this one. Yeah, you cannot exchange into a partnership or syndication because when you own real estate in an LLC or partnership, or you technically do not own real estate. Technically, you own a share of a partnership that owns real estate. And in 1984, the 1031 code was amended to specifically say you cannot exchange interest into or out of a partnership. So when someone wants to go buy something, let's say Jason, you and I want to do an exchange, we want to exchange our individual properties and buy something together. We have to own that new property as tenants in common because we have to own our fractional piece of that real estate. We cannot create an LLC and contribute money to that LLC or partnership or syndication in order to qualify, because that is not considered to be direct ownership of real estate.
Okay, great. George, would you like to turn on your mic to ask your question?
Yeah, hey Ron, hey Jason, thanks. So this question is about, can you 1031 a house hack? Some more context around this. I bought a primary home some years ago and I started renting out rooms. And then over time, I eventually moved out, but I still maintain some of my stuff in the house. My mail and tax returns still get sent back to the house. If I ever want to 1031 this house, is that possible? And if not, what do I need to do to turn it into 1031, assuming that it's beneficial for me financially? Like if my capital gains are higher than the allowance.
Yeah, so the question there really boils down to how do you file your tax return? Now, do you file your tax return? Well, first off, do you even show the rental income? Because some people don't show all their rental income when they're renting rooms out of their house. So in that, to the IRS, what you're telling them is still just your primary residence. And so that really boils down to that. What are you showing on your tax return? Are you showing a percentage of your property as being the rental portion? Now, one thing I do want to be clear about, and I don't know if there are any accountants on the phone or on the line, though I do recognize a couple of names of people who I think are accountants, which is interesting. Whereas a home office has a black and white definition and a black and white recipe that the IRS says you can use for a home office, the same thing does not happen for renting rooms out of your house. So a lot of accountants are actually very hesitant or suspicious about how to break up, how to say what percentage of that house is the rental portion of it and how much of it is the primary residence portion. Because you might say, well, it's a 5-bedroom house, I'm renting 4 bedrooms, it's 80%. No, it's not, because you all use the kitchen. You probably mostly use the bathrooms. You're all using all the common space. And so that's where that gray area kicks in that a lot of accountants really don't know how to adjust. So you have to be really careful about that. But in your situation, George, I would say really it boils down to, if you haven't been, then you're probably going to want to start showing all or the majority of the property as being rented out.
Got it. And then is there a time frame or time box on that last recommendation?
That's a question for an accountant as well. Again, I don't know if there's anything specific in the tax code. Most accountants I talk to like to see stuff for at least the last 2 tax returns.
Okay, got it. Thanks.
Okay, great. Thank you so much, Ron. I mean, like I said, I love your presentation and I love your session. Kind of to Tracy's point, like, you get right to the point, straight, direct, straightforward. So and great questions too, by the way, guys. We'll have a couple of minutes. There are a couple of things I want to touch on in terms of questions or some of the hot topics. And as well too, if you have a minute, we do ask for a $5 voluntary donation to help just cover the Zoom hosting costs, the Meetup hosting costs, those kind of technology fees. I'll put my memo in there in the chat. But I was curious if I know we talked about this offline, Ron, and we know the answer, but can you touch on a little bit how Prop 19 factors into 1031 exchange, or just some general estate planning tips for folks about, the step up in basis and all that?
Okay. So for the person who lives in Florida, I apologize because this is pure California we're talking about now. As most of you know, back in November, we voted in favor barely for Proposition 19. And Proposition 19 has to do with property taxes. And it replaces, or it amends in many ways, replaces what we have in Proposition 60, 90, 58, and essentially has two major components to it. And I get, and Jason is right, I'm getting asked all the time, what does this mean for 1031? And the answer, as far as exchanges goes, really pretty much zero. And I'll explain why. The Prop 19 has two major components to it. The first one is for people who are either over 55 or who are disabled or who lost their house due to natural disaster. They get to move now to anywhere in California and take their old property tax bases with them. Before, you had to buy a property in your own county or within certain counties that would allow it, and you had to buy something less expensive. Not anymore. Now you can go from San Francisco to LA to Humboldt County to Fresno to anywhere, and take your property tax basis with you, again, for disability, if you're over 55, or if you lose your house to a natural disaster. The key here, though, is primary residences. So again, nothing to do with 1031 exchanges as far as that goes. The other part of it, the other aspect of Prop 19, which is the parent to child, and in some case parent to grandchild transfer. We had passed somewhere in the 90s an amendment to Prop 13, which would allow the parents to give real estate, whether it's give, sell, or inherit property down to their kids, and have them keep their property tax basis. And this was good for their primary residence and up to $1 million of other real estate. And that $1 million was measured in property tax basis. So we had a lot of people inheriting investment real estate from their parents that the kids were able to keep the parents' old property tax basis, or they inherited mom's old house and that the kids are going to rent out and keep mom's old property tax basis. Well, that's pretty much been gutted. Now, the only transfer is from parent to child, or if the child are deceased, it can go from parent to grandchild. And it's only if the property was the parent's primary residence and will be the child's primary residence. And if it's not both it's not the parent and child primary residence, then you cannot pass the property tax basis to the child, whether it's by gift, inheritance, or sale. So it really restricts that Proposition 58 down to a very few. So what you're going to see now is a lot more people who've inherited property are going to be selling it because they've lost the real advantage of that property tax basis in some cases. I got a couple of clients recently who they're looking at inheriting a $3 million property. Well, that's $3,000 a month in property taxes, and unless you've got it, you're making a hell of a lot of money in rent. That's a hell of a nut to be able to crack if you're going to make that property a rental property. So I expect to see a lot more property being sold. Again, though, primarily we're talking transferring a property, and also typically when you inherit property, because you get that step up in basis that we talked about, you probably can, if you're going to sell the property, you may not have much of a gain or any gain at that point, and you probably don't even need to do an exchange. So I think it will make real estate move faster. There will be more transactions because more people will sell when they inherit property, but I don't necessarily seeing it really change the 1031 world.
Can I just clarify something too? So, I mean, you're saying for Prop 19, it's really only about the property tax basis, right?
Correct.
But for you can still, regardless if it's primary residence or not, you can still step up basis for that capital gains calculation, so to speak.
That's correct, and that's actually something that people get really confused about. They talk about basis for a property. Well, when people start talking about basis, I say, time out. What basis are we talking about? Are we talking property tax basis, which is what you pay the county every 6 months, or is it capital gains tax basis, which has to do with paying state and federal capital gains tax? And Prop 19 is strictly associated with property tax. It has nothing to do at all with capital gains tax.
Right. Okay. Yeah, and that was my understanding when we were talking. It's like, okay, well, it sounds like it's actually kind of irrelevant. So,
Yeah, exactly.
and great. Thank you so much, guys, for George, Nathan, Larry, and Annie. Let's see if you, John, if I may, since we're talking about basis, I wanted to there's one question because I got tripped up myself on this. And it might be a little hard without some kind of like actual illustration, but Ron, can you talk a little bit about how your depreciation schedule is calculated or how that works after you've exchanged a property? Because to be honest, up until 2 years ago, I thought it resets, but that's actually not how it works. Can you
Yeah.
help verbally, hopefully explain a little bit that part?
Let me do a real brief thing about what depreciation in general. Depreciation is this tax write-off, this magical tax write-off that you get to keep, or you get to take on your tax return every year. And what that depreciation does is it's based on the improvements on the property. So let's say you buy a property and for $275,000. Well, it's a residential piece of real estate. You get to depreciate that over 27 and a half years. And that depreciation condo at 20, but it's only the structure, not the land. So let's say it's a condo for 27.5 years, 275,000, you get to depreciate $10,000 a year on that property. The key is though, when you sell that property, let's say you sell that property now for $500,000. That $500,000, buy something else for $500,000, you're not having any new net investment, so you do not get any more depreciation. Now, if you still have depreciation left from the first property, you still get to take that remaining depreciation going forward. So if you 10 years into it, you sell the property, do an exchange, you still have 17 years worth of depreciation remaining. Sell that property for $500,000 and buy something for $700,000. Now you have $200,000 in new net investment, and that may give you some new depreciation that you can take. Does that help, Jason?
Yeah, it does. I mean, like I said, I was totally misunderstanding this, and I figure there's a chance folks out there too might be under the same impression, and I don't want people to get tripped up. John, do you do you want to turn on your mic? Did you say you have more questions on related to Prop 19?
Sure, I have a question. If like my children inherit my house, and they're trying to avoid the taxes, could they just simply move in for a couple of years to avoid that property tax? There's been no information about what the time frame.
Yeah, actually, we are really seeing the Board of Equalization come out with rules about this. And in fact, it's funny because Friday I'm giving a longer presentation about Prop 19. So I started reading these things from the Board of Equalization. And what I thought initially is exactly what you just said. Well, I'm going to inherit my mom's house. I'm going to move down there for a year, keep it, and then move back to here in Northern California. No, the day you move out, you get a property tax reset. So if they want to move into the property and live there the rest of their life, yeah, they can keep your old property tax basis. But the day they move out, then they hit you with a reset back to the value of the property when you passed away, not when they move out, but when you passed away. So okay. There's not a way for them to basically game it and then move on.
Okay, thank you.
Okay. Great. Well, thank you so much, everybody, for joining today. Ron, I'll share info with folks or anybody that might have an exchange or needing more help, me included. Fingers crossed. We have 2 properties that are getting ready to list. Let's see. If there's anything else, I'm checking the chat real quick. We're gonna go to the breakout rooms. Hopefully, folks can stay a little bit. We're gonna do 4 or 5 rooms. But thank you everybody so much for joining again. Great content, great questions and answers, Ron. Be sure to join the Facebook group, stay connected, keep an eye out for future meetups. I actually haven't published it, but I just confirmed it that for February, I'm gonna have Aaron Norris from Property Radar to talk about how to get off market deals and how to leverage data for some hyper local marketing. So be sure to look out for that one. That one's gonna be super cool. And I'm not hyping it. Like they always bring it too. So with that, I'm gonna assign the breakout rooms. And Ron, feel free to join us as well for further discussions or to network. But if you got other stuff to do, totally understand as well. So okay, well, with that, I'm gonna open the rooms. Let's see. Cool. Well, I'll see you guys there. That's weird. Hold on. Why am I not able